good evening to all our audience that's joining us. I'm Tanvi Dubey. I lead marketing for Chiratae Ventures. And I'm really excited to host this conversation with a superb set of leaders with me here today that you can see on your screen. Now, the objective of this conversation is to encourage women to actively participate in financial decision making. And there's a straightforward reason why we are recommending this. Now, hold on while I get some data that I want to share with you. So data has shown that in general, women managed portfolios lead to better returns. A study by Fidelity Investments highlighted that on an average, women's portfolio earn an extra 40 basis points or 0.4% comparatively. Now, while 0.4% might not seem like a windfall, compounding of this edge can make a splash over time. There are simple but lesser known reasons behind higher returns from women managed portfolios. Women tend to take a more long-term as well as goal-oriented views of their investments. Additionally, the same study found that men trade 55% more than women, leading to higher fees and transaction costs, but not necessarily better overall returns. Further, the study highlights on average, women portfolios are also more diversified, which provides better risk-adjusted returns while protecting their investments. And as if all this is not enough, women also tend to save more and combined with better returns, end up building more wealth. Now, apart from taking better control of their finances, we will also want to explore today how VC as an asset class fits into this diversified portfolio of high impact women and how investing in VC can work in favor of achieving a woman's long-term financial goals. Joining me are our experts, three extremely accomplished wealth managers, and a VC who's also a colleague to shed more light on these subjects. At the end of this conversation, we'll open up for Q&A, but feel free to type in your questions here as the conversation's on, and we will take all these questions at the end of the panel. Now, with that overview, I'm very happy to welcome Nidhi Chawla, Director Investments, Kotak Private Equity. Welcome, Nidhi.
Thanks, Tanvi.
Vidhi Ruparel, Senior Director, ASK Private Wealth. Anupama Sharma, Executive Director, 360 ONE Wealth. And my colleague, Mandeep Julka, VP, Chiratae Ventures. Now, I want to just go around the table and have all you ladies introduce, take a minute and introduce yourself, and then we'll dive in right into the set of questions that I have ready for you. So maybe start with maybe Anupama. We can go alphabetically.
Sure, Tanvi. Thank you. So my name is Anupama Sharma. I essentially lead part of the business at 360 ONE Wealth. I've been in this business of private banking and wealth management now for over 22 years. Chartered accountant by qualification. My previous two stints were with Kotak Wealth and Citi. So 10 years with Citi and about 11 years with Kotak Wealth. So that's my background. Happy to be part of this panel where we are essentially going to cover how women make great investors and great investors across asset classes and regardless of their investment experience. So of course, we're going to discuss more in detail, but glad to be here.
Thanks, Anupama. Mandeep, on to you.
Hi, everyone. This is Mandeep here. I'm part of the Chiratae Ventures team, and I look at early stage fintech investing as well as India fundraising for the firm. Very happy to be here and looking forward to this conversation with four amazing ladies.
Thanks, Mandeep. Nidhi, can you please go ahead and...
Yeah, sure. Hi, everyone. I work with Kotak Private Equity. I head the fund of funds business at Kotak Private Equity, and I also do late stage tech investing. In fact, prior to the private equity role, I used to head the alternates business for Kotak Private. And prior to that, I was handling alternates investing for Avendus Wealth. So have bulk of my career has always been on the alternate side and really enjoy this space. So yeah, look forward to interacting with all the lovely women on the panel.
Thank you, Nidhi. Vidhi, on to you, please.
Thanks, Tanvi. My name is Vidhi Ruparel. I'm a senior private banker at ASK. I was one of the first few advisors as part of the ASK team. So I've been here for almost 17 years now, and this is what I do, right? I work with some of the largest families, advising them on their portfolios and as the introduction that Tanvi made, it gives me a great kick, that some of the largest career private bankers are all women. We're all here. We're the ones who are advising these ultra HNI clients on their portfolios. So to that extent, it breaks the stereotype that women don't know or understand investments. And I'm so happy to be a part of this, because this just institutionalizes everything that I think all of us have been planning to do in our own way, for the nation at large.
Thank you, Vidhi. I have to say this to our audience that, we had a call, sync up call a couple of days ago, and I was overwhelmed by the kind of passion that each of these leaders brought to the front. And I hope that they're going to be unleashing some of that today. And while we have a set of very interesting questions, I would encourage all of you to chime in if the question is not addressed to you as well, if you have a point to make. So Nidhi, let me start with you. And the first question is, can you share a little bit more about why women should lean into investing?
Yeah, I think, to be honest, I mean, this is a heavy topic, right? Lean into VC. Prior to that, at least we should have more and more women lean into investing. I mean, you made some very good points on how women are great investors, but the number of women investing is still far and few. I mean, if we just take a survey around our own male colleagues and ask them how much of their wives are in fact even involved in even knowing where the money is going, what is the money getting saved for, that is very, very, that will be a very limited number of women who will be participating in this activity. So first and foremost is lean into investing. And to be honest, I think it is not by lack of intention. It's just that I feel that there is today a lot of information out there. There are lots of tips and tricks, lots of influencers, lots of rules and thumbs, and it can get very overwhelming for an individual to start his or her investment journey. I think the first step, the 101 to lean into investing is to make it personal. I'll give you my own example. When I started working, I was a simple software engineer, and all my money was being handled by my father. And he would invest in literally for any instrument that helps in saving tax. That was the only purpose where investments would go. And soon enough, I started realizing that, I have certain aspirations, right? I wanted to buy a house. I wanted to save for my education. And I realized that, these are the goals. If I'm going to work for that, how should my money the journey of my money should be towards these goals. And that's when I started leaning into investing. So you have to have certain goals. Women in their families, they can get involved by just knowing, at least to start with, if the money is getting saved, is it sufficient for, say, children's education, or a particular goal like buying a house, buying a car, a particular vacation they want to take, every year or every 2 years, or for that matter, even retirement. So I think the first step is of leaning into investing is getting emotionally invested as to why you are investing. And I think that will allow you to have certain direction as to how you go about, giving a time frame to a goal, having an asset allocation. Of course, we're going to talk about all of this, in this conversation today. But at least that's 101 of investing. So,
thanks, Nidhi. Anyone else wants to chime in and add something?
Yeah, to add to Nidhi's point, she kind of said that she was giving her own example where she said, she kind of had her own goals and, where she had certain aspirations where she thought it was very important to adopt a certain style of investing in order to achieve those goals. So clearly what we also see when we deal with clients and we deal with families and where women get involved in the portfolio construction and management thereafter, you actually see women, wherever they do get involved, it's not across the board, but you see them aligned to their life goals and values and aspirations very, very clearly. So I think that helps in long-term, sustainability of returns, which is very, very important, because women by nature are less impulsive. And that leads to ensuring that, you kind of have a long-term portfolio. And we've all seen that, right, in our respective careers of wealth management or private equity or investments, that, the longer you stay investing, the power of compounding works far, far better. And given, women kind of, maybe they don't have that kind of an investment experience, but, given that they are more aligned to the goals that they've set for themselves in their lives, and, they kind of ensure that they, stay long term in their investments. And even if that means staying passive, right? But it results in low cost, which adds to the return. So clearly, we encourage at 361 Wealth, we do encourage women to get, of the families to get involved. We do basic training sessions for them to ensure that, we kind of see them getting involved in the portfolios, and it does add value for sure.
So Anupama, speaking of portfolios, what do you think
Yes.
is the single most important tenet of portfolio construction?
Okay, single most important tenet of any portfolio construction is essentially, diversification. Diversification clearly reduces your risk and ensures that you get long-term sustainable returns in a portfolio. Now, how do you do this? You do this by achieving or kind of following a framework. And this framework is as simple as following an asset allocation. So looking at investments across the universe, across asset classes, your broad asset classes are, of course, debt and equity. And then you bring in, some amount of alternates in your overall investment framework, which could be alternates either in the private space, which is the private unlisted space, which could be venture capital. It could be, so basically the alternate space we divide into early, mid, and late stage, right? And, or it could be structured credit on the other side if one is looking at high yielding debt. But essentially, what is very, very important in a portfolio construction is to look at diversification across asset classes. And within those asset classes, diversification, when you look at equity, it has to be diversification across market cap, diversification across sectors. When one talks about debt, it has to be diversification across the nature of the instrument, but more importantly, the quality of these instruments, right? Because when you're talking debt, you have to kind of ensure that you are, kind of aware or sensitive to the two risks which are associated with debt. So essentially, one has to be, looking at different categories of investments. It could be as simple as G-Secs, PSU bonds, corporate bonds, but well diversified so that you achieve your return objective. And now you bring in the alternate asset, which is essentially VCs, or it could also be, like I said, in the private unlisted space, it could be, VCs, which is more early stage investing. It could be mid or late stage, which is pre-IPO. But the reason why one looks at this alternate asset is also because, and that's where I see women, even in the alternate set bucket, you may have less investment experience, but you see them doing better even there because they have the patience, they like to understand in detail, they evaluate and get into each of these asset classes only where they have kind of assessed the risk and the associated reward with each of these asset classes. So I think clearly when you're looking at a portfolio construct, diversification across asset classes and within those asset classes, with across different categories of each of these investments is very, very important to ensure that you have a healthy portfolio with long-term, stability and consistency of returns.
Great. Thanks, Anupama. While we're on that very important question of diversification, I think I would like to pull in Nidhi here and see, why does diversification matter in an investment portfolio? And Nidhi, if you could share your perspectives on the same.
Yeah, so I mean, most of the things Anupama pointed out, the basic foundation or the basic principle is to reduce the risk, right? To reduce the volatility, reduce exposure to a particular nuance of an asset class or a fund manager, or even, for example, time horizon. Because one most important element of diversification is time diversification. All the good opportunities will not come to you to invest in one particular time, right? You have to keep investing year after year. I mean, mutual funds, they keep saying stagger your investments, do SIPs. So similarly, time diversification is very important. Every fund manager, so let's say you decide to invest in equity as a part of your asset allocation. Within equity itself, there are products, right? There's mutual fund, there is alternate equity like private equity VC, or there is PMS. Each of them have a very different nuance. Then, of course, there is different types of fund managers. Somebody could be a value investor, somebody could be a momentum investor. So sectoral diversification is important, choosing different sectors. So each of, if you see, the purpose is to have an element of value diversifier, a momentum diversifier, whether you want a cyclical sector or whether you want a defensive sector. The purpose is reduce the risk to every element. You reduce your risk to equity by having some bit of fixed investment, reduce the risk of value investing by having some bit of momentum based investing. So you basically keep hedging in every form and manner to reduce your overall risk. And that is the basic purpose of diversification. And of course, remember not to over diversify as well, because over diversification just increases the cost without adding any extra element of returns as well.
I would like to add a point over here. We are talking about investing and diversification. I think I would just like to highlight to my audience that it doesn't matter what is the corpus of your money that you have to manage, right? It can start from as low as thousands of rupees, and it can go as high as crores and multi crores, whatever. But the important fact over here is that you need to get into a mindset of managing your own money, irrespective of the corpus you have. And over a period of time, as your corpus increases in value, you can keep adding different assets as it suits your risk profile. But that mindset of starting to manage your own money, getting control of your finances, having goals that you want to achieve with your money is extremely important.
Thanks, Mandeep. We'll keep on the topic of diversity, and I want to bring in Vidhi here and get her to share her views. So, Vidhi, how to build diversity when it comes to one portfolio? How does one break this down?
Thanks, Tanvi. I do think that diversification itself, like both, my other colleagues, etc., have mentioned, it's a very wide concept, and there isn't like a one size fits all. It's not like what works for me will work for Anupama, and the same will work for Nidhi, right? So it's very important to do a couple of simple things when one is identifying what their asset allocation should look like. Very, very important, investment goals, objectives need to be very clearly defined at the beginning. Also, a huge assessment of what one's personal life cycle stage or personal money situation is also plays a very important role. So if I had to really break it down, when you have a bucket of money, now whether that's a small bucket or a large bucket, it's important to identify and articulate clearly what that bucket of money is going to do for you returns wise. So we have to consider things like time horizon of investment, how much of the portfolio really is required to be liquid to assess any short-term requirements, what life cycle stage one is at, when one is bringing out the portfolio allocation, and how much risk one is willing to take for that particular bucket of money. So ideally, I say divide the total pool into a core portfolio and a little bit of a peripheral portfolio. Like your core portfolio could include things like low risk, medium risk, and high risk items. Low risk would typically be, bonds, fixed deposits, PPF investments. Gold is considered to be a very good investment amongst women. We can look at some moderate risk items such as mutual funds, index funds, ETFs, maybe a bit of insurance to that extent. And then you want to go into a high risk portfolio, which is more equities, commodities, all your PMSs. And then if you're feeling very, very brave, venture cap, right? Unlisted private equity investments, because there's some terrific work. I mean, I think India as a country is very well digitized right now. So the number of people coming out and fearlessly chasing passion and dream as opposed to chasing a job scenario, one needs to lean into that and optimize on that fully, right? But you have to be very, very cognizant that the return risk matrix when it comes to investments is very, very proportional. So higher the risk, higher the return that you can expect from these investments. So you limit how much risk you're willing to take for that bucket of money, and then go about building your portfolio with different elements like that. I think that gradually will build some kind of diversification in your portfolio.
Thanks, Vidhi. Any of the other panelists want to add anything to this?
Just one point here, and both Mandeep and Vidhi kind of alluded to the fact that the corpus doesn't matter, diversification is what matters. So, and basically there are solutions available for everything. If you want to diversify with very little corpus, just an equity debt, if it is very small, there are mutual funds itself which are available, which do that diversification for you in different asset classes. You have a larger corpus, but still not sufficient to have, PMS or AIF added to it. Then you have, or you can build a portfolio of only mutual funds to start with in equity, debt, and gold or REIT for that matter. And then you keep on adding those building blocks as and when the amount you have available. Even, for example, diversifiers are available within AIF. You have multi-asset AIFs available. You have multi-fund fund of funds, private equities, VCs are available. PMS is doing diversification for you. So I think while people think that if I have to diversify, I need a lot of money to put across so many fund managers, so many asset classes. There is a solution available for everything. And money should not be a constraint for that basic tenet of portfolio construction.
And I think Nidhi, just one more point, Nidhi mentioned a very, very pertinent point. Over diversification also sometimes kills the performance of the portfolio. So while diversification is important, but over diversifying sometimes leads to buying the market, right? All of us look at a portfolio construct because we want outperformance over and above the benchmark. The benchmark could be for equity or Nifty index. For debt, it would be any bond index, say a crystal bond index. But we are looking at a construct, we are looking at diversification so that we outperform the benchmark, right? And that cannot be achieved if you end up over diversifying, because you'll end up buying the market. So very important. Yes, diversification is very, very important to maintain hygiene of the portfolio. But at the same time, you need to keep the right balance across, asset allocation, of course, is basis your investment goals. Then within that asset allocation, how much do you diversify across different products, and categories of product classes is something that you should be guided by your advisor.
So, part of that is what my question to you was, Anupama, to how to get access to diverse investment options.
So essentially, diverse investment options, here I would kind of like to talk about investing on your own or kind of taking guidance from a particular wealth advisor. So when you look at, investment framework, you kind of look at, a simple strategy. And I think Vidhi touched upon that. You kind of look at, a core part of a portfolio and you look at a satellite portfolio. Now, core portfolio will essentially be a portfolio which will be a benchmark hugging portfolio, where the endeavor of the portfolio is essentially to outperform by, for equities by about 2.5% over equities, over the benchmark, which is Nifty. And when you look at the debt, of course, depending on your risk appetite, you would look at either a plain vanilla high quality debt portfolio, which will give you benchmark like returns, or if you're looking at generating some alpha, then you try and bring in some high yielding debt opportunities. Then comes your satellite, which will essentially be your alternate categories. And the alternate category of investments in satellite could be either private equity or private credit, like I mentioned earlier. Now, in order to get access, even for the core portfolio, right, which is as simple as maybe index funds for equity allocation, because what one has realized is that if you look at a good blend of passively managed index funds, you can actually achieve or kind of manage to get the outperformance. Or look at some focus strategies on the equity side. Essentially, even for that piece, to get that blend right and to ensure that there is some outperformance coming on that portfolio, it is important that you kind of get guided and you take the guidance of of a wealth advisor. And the reason I say that, because sometimes we all think, and this applies to us as well, sometimes we all think that, okay, if you're kind of going to be using a wealth advisor or the expertise of a wealth advisor for plain vanilla core portfolio, then it probably adds to the cost. Yes, it does add to the cost in terms of advisory fee or in terms of transaction costs. But on the other hand, if your outperformance, in a way, kind of takes care of the extra cost that you pay, I think then you are pretty good on the portfolio. And when it comes to diverse opportunities in the satellite bucket, this is again depending on the investment goals of the investor, and one can look at different investment opportunities basis your goals. And of course, each investment opportunity in the alternate bucket, whether it's to do with the unlisted space on the equity side or private credit on the high yielding debt side, it has to be clearly aligned to your investment goals, which would be in terms of return expectation and the investment tenure horizon on the portfolio. Because clearly, the alternate objectives require you to be stayed invested for longer periods of time. Of course, these are high risk, high return opportunities, and hence have to be aligned to your investment goals, your risk appetite. And one must look at taking an allocation in these category of investments only if you have the investment horizon on the portfolio, one, and two, understanding of each of these, asset classes. That's very, very important. So, so that's, anybody wants to add something on this point? Happy to kind of.
Please go ahead.
I'll add over here.
Yeah.
As I mentioned, I look at fintech at Chiratae, and
Yes.
part of fintech is the entire digitalization of the wealth management industry, which is happening. So wanted to bring out that point. I think, and it goes back to the earlier thing which we were discussing about, that the corpus is not important. So if you just want to start understanding what is out there, there are multiple digital platforms available in the market right now, which will train you, which will give you access to information, access to case studies, access to knowledge around what kind of products are there, how to view those products, how to learn about them, and how to construct your portfolios. Apart from gaining knowledge, there are also multiple robo-advisor platforms available out there. If you just want to start investing in different kind of basic products and move your money slightly away from the staple earlier products of FDs and insurance products, right? So one thing I would put a caveat over here is that when you look at these robo-advisor platforms, and I in particular see a lot of them in my daily life, right? So just be careful that what kind of expense ratios they are charging you across different products. Some of them are offering you direct products, so direct mutual funds, direct ETFs, where the expenses are going to be significantly lesser than other platforms, which are just distribution platforms, right? Which will just sell you products, but still charge you the same amount of expense as your neighborhood uncle who's going to sell you those mutual funds might. So that's the caveat I wanted to add. Apart from basic robo-advisor platforms, which will give you mutual fund options and debt options, there are many other exotic platforms also available these days, which will give you fractionalized real estate, fractionalized debt, leasing options, etc. So at the end of the day, it depends upon what your risk profile as an investor is. And personally speaking, if you're just starting out, start small, start with lesser risky ones, and gain a bit of experience, expertise, knowledge, work with somebody else, and then build your portfolio for more exotics.
Thanks, Anupama and Mandeep.
And simplicity, just to add to that point, I think simplicity in portfolios works the best. So, the more you kind of keep the portfolio simple, you will see more consistent and long-term sustainable returns. So that's very, very important. Of course, exotics add to the return depending on your risk reward parameters, etc. But that should come in only later once you understand each of the asset classes.
Great. I think some very interesting points being made by all of you, and I can't help but scribble some pointers and notes on the side. And now moving from our portfolio construction to diversification of portfolio, I want to come into the topic of lean into VC, and I'd like to probably go to Nidhi for this and say, Nidhi, what is VC and why should one include it in one's portfolio?
Right. I think Shark Tank has kind of made it a very popular thing to invest and made startups very, very glamorous. To be honest, so basically, if we take a company goes through has multiple life cycle stages. The earliest one where they're just starting out, they are funded by friends and family, and that is the angel round. then they go out, delivering some amount of revenue, the company picks up, starts selling some products, and that is when the venture capital stage kicks in, funded by an institutional investor, VC funds, as they are called. And then the company matures, gets into growth stage, needs money not for proof of concept of their product, but largely for growth. Having established that the product market fit is working and they need money for growth capital, and that is where private equities kick in, and then you have your late stage fund investing into companies when they're about to go for an IPO. So that is basically all sorts of alternate equity right now we're talking about, starting from angel investing to private equity. Venture capital is when the company is making some amount of revenue, still maybe in the proof of concept, or may has just established the proof of concept. All sorts of VC investing also happens. By and large, a couple of characteristics of VC. It's a risky asset class. So it's an add-on to your portfolio. You are investing into a VC for higher returns and diversifying to get into business models that are not available in the public market. So you are adding a diversified layer to your portfolio, and you're also adding a portfolio asset class to give you more returns. Typically, VCs actually end up giving 10 to 15% IRR outperformance over public equity, but the returns tend to be back-ended. I mean, they typically you have to invest for a period of over 10 years, and you invest, and most of the money starts coming in fifth, sixth, actually, sometimes even 8th, 10th year onwards. So don't expect immediate liquidity. Go in with a mindset that you're going to see your money after a long period. You will get your reports mostly every quarter from a VC fund manager, and in the initial years you will only hear of companies dying, and don't get alarmed, because out of say 20 companies a VC fund invests in, they will see at least 30 to 40% die. That is par for course for a VC fund. The investment returns are highly skewed. Only 20% of the portfolio is going to return 80% of the returns that a fund generates. So expect that to happen, and do not have your blood pressure going high. And of course, we will also learn about how to pick a good VC fund manager, what to look out for one. But one thing that always gets asked is that Abhi Shark Tank jaisa things are available. Why don't we invest directly? VC investing is a very disciplined investing. You cannot start investing on your own in a single company and say that, hey, I have done my job of VC investing. I have invested in a company in an early stage. As I said, only 20% of your portfolio gives 80% of the return. So investing in 1, 2, or 3 companies will not make your VC portfolio. This part of the portfolio has to be highly diversified, and not just diversification, not just investing in many companies. It also requires following up with a lot of a lot of portfolio founders. And last but not the least is access to good companies. It's like buying a good shirt. A good shirt is made from good raw material. A good fund or a good portfolio outcome will come from good raw material, which is deal flow. And good deal flow comes to a good fund manager. It doesn't come to individuals so easily. So best would be to go via a VC fund. So yeah, I mean, that's effectively what is VC and what is VC fund investing.
Thanks, Nidhi. I think that was a great analogy to get the point out. And I want to pull in Vidhi here at this point. So Vidhi, if you could talk a little bit about why invest in VC, especially as a woman.
Tanvi, when this panel actually was put into place, I remember doing some amount of research, because as a wealth manager, you're constantly reading articles, Harvard Business Review, Yale. A very alarming number came to the fore, right? The venture industry predominantly is pretty like a male-dominated society. It's a boys' table only. Only 3% of the global venture cap money is given or is channeled into female-backed entrepreneurs. That's a seriously low number. If I have to go to the other side and say how many of these investors are women, it's only 15% of these investors are women. So clearly, this is an underrepresented industry as far as VC is concerned for women in general, right? So I said, let's break this into two parts. One, do women and will women make good investors within the VC space? And two, I mean, why should women invest in VC per se? So I'll address the first point first. Women bring really unique perspectives on businesses. They have a larger focus on soft skills, team management, people management, which can be hugely beneficial to companies. Two, women are far more resilient and therefore they are likely to focus on the longer term objectives of a company. And like Nidhi very correctly said, it's a much longer game, right? This is not like you put in money today and within a year you remove and you've doubled and tripled your money. No, it doesn't work like that. Like every business needs time to grow. Some of these companies and investments need time to grow as well. We also have a tendency to be far more financially disciplined than men and frugal. So to that extent, we're likely to save more money than men in the long term, which can help fuel investments, in some of these early stage companies. Also, women in every household, you will notice, they control 70% of all products and services that are being included as part of their family's development. So to that extent, they may be better equipped to identify new trends, new ideas that could like fuel the consumption story as far as India is concerned. So to that extent, there is enough and more rationale why women will make great investors as far as VC is concerned. Now, whether they should or they should not invest in VC, again, goes back to the asset allocation game. You figure out, within your overall portfolio, if there is a space. And ideally, as a wealth advisor, I strongly recommend not only men or women, but like at least 10 to 15% of your portfolio be allocated to some of these unlisted companies. I don't mean to say become another Shark Tank or judge and go ahead and put your money wherever, but yes, find a more institutionalized channel of investment. Because whether or not women should invest in VC then becomes a very gender biased argument, which is something that we're trying to move away from. The truth is, any investor, whether it is a man or a woman, must look at investments more from a return generating perspective and risk appetite. This has nothing to do with gender. And so I don't see any reason why portfolios of either men or women should differ in allocation to VC or any other asset class for that matter, as long as their life cycle stage, objective, and their goals are similar, and their ability to taking risk is similar. But again, to reiterate what Nidhi said, a lot of restraint needs to be observed because when one is investing in some of these businesses directly, they come with their share of risk. So limit the allocation to this asset class and definitely do it through a fund.
Thank you so much, Vidhi. Mandeep, would you want to add on to that?
Yeah, I think Nidhi and Vidhi both covered the VC part very well. And I'm very happy that, we are all bringing awareness about, why to get your hands dirty as a woman with investing and how to go about it as well. Now, why we should be investing in VC in particular, it's a risk reward ratio, as was pointed out earlier, right? VCs in good VC managers historically tend to give much more than your comparative public market returns, right? So typical expectation, if you're thinking of investing in a VC product, should be 25 to 35% net IRR. And when I say net IRR, that means net of your expenses and net of your carry, because this is, as Nidhi had mentioned, this is a long-term gain. If your money is locked in for more than 5 to 7 years, then you do expect at least that kind of a return. Whereas a public market, which is much more liquid, you can be happy with a 10 to 15% average returns from diversified public markets over a similar period of time. So that's the main reason why you would want to invest in VC, which is a longer term horizon, but a much larger expectation on your returns as well. Now at Chiratae, we've been doing this for over 16 years, and thankfully our funds have been subscribed to by global as well as Indian investors over a period of time repeatedly. In fact, when we started, it was mainly one institutional global investor which invested in us, but over the last 16 years now, out of the total 1.1 billion that we manage, almost half of it has come from Indian investors. That kind of goes to show that Indian investors in general have warmed up substantially to investing in a long-term, higher risk asset class, but they've also become sophisticated enough to realize that this asset class adds value to their portfolio. And how much value or what proportion of their volume to invest in, I'm sure the other ladies can add very well. But we in general, whenever we go and talk to any LPs, we recommend not more than 15 to 20% asset allocation to the entire private section of your portfolio. So, and that should also be diversified across VC, PE, whatever you want to invest in, early stage, late stage. But in general, I would say diversify it across stages, and make sure you diversify it across sectors also. We do have, sector specific thematic funds in the market across stages, but unless and until you're very comfortable and have strong expertise in those kind of sectors, I personally advise against it. And finally, one more thing I want to add. I know a lot of media coverage happens around, the kind of returns VCs generate, or the kind of valuations which are out there in the market, and the unicorns and the Shark Tanks of the world. But at the end of the day, at least at Chiratae, we also measure our impact on society through our investments. So some of the numbers that I can quote is because we track these numbers on an annual basis. As of last year, we had impacted more than 3.5 million farmers in the ecosystem through our agri-tech investments. We had facilitated more than $28 billion of financings as well as insurance premia for the people we had impacted. And even in healthcare, we've reached more than 40 million people. So it's not just about stellar returns, it's not just about unicorns, and it's not just about early stage companies failing, but it's also about creating substantial value for the society, for the economy at large.
Thanks, Mandeep. While we're on the subject of VC, my next question was for you. So I'm going to go right ahead and ask you that. So what are some of the common questions LPs ask while evaluating a VC manager? And I'm sure you've on the table gotten plenty of them. So if you could talk a little bit about that. And that sort of also covers that what are some of the things they're looking for in a VC fund, right? So if you could cover that as well.
Yeah, happy to. So typically when we go out into the market and talk to LPs, some of them are more sophisticated than others. But while you are evaluating any VC manager, there are 4 to 5 things to always keep into your mind from my perspective. I'm happy to hear, Nidhi, Vidhi, and Anupama, your views. But first and foremost, what's the track record of the VC fund manager that you are evaluating, right? And that track record has to be across different business cycles, not just last 2 years, 3 years, or 5 years. Typically, your one fund life only will extend up to 10 years, right? If you're lucky, then 10 years, otherwise even 12 years at times. So those 12 years will necessarily see some or the other different business cycles, right? We've been around for 16 years. We've seen global financial crisis. We've seen demonetization. We've seen the heady days of 21 and the low days of 22 also, right? And so far, a lot more in between. So what has been your track record across these business cycles over a long period of time? Second, how do you measure this track record? Usually, what a manager might tell you is what the gross IRR return is. However, you have to dig deeper and ask for a net IRR return, net of expenses and net of carry. And not just IRR, you also have to ask about what the DPI is, right? What the distributed to paid in capital is. DBPI is also important, but those are mostly paper returns. What is the ultimate cash you got in your hand, given the amount of cash you gave into the asset manager? That becomes very important. Thirdly, team. How good the team is in terms of their sectoral knowledge, how long their VC experience has been, and how long the team has worked together. All these factors around team become extremely important because, as I think Nidhi had mentioned earlier, one of the strongest differentiators of any VC investor in the industry is your deal flow. And the longer you've stayed in the industry and you've garnered a good brand name will determine how good your deal flow is. And the team's stability, the team's sectoral knowledge, what kind of hot pieces they put out in the market will all flow into how good your deal flow is. I'll give you a metric over here. So at least at Chiratae, we look at more than 4,000 deals a year. And for every deal we do at the end of the day, we will assess more than 150 to 160 deals, other companies for that particular deal. So that's the kind of vast amount of knowledge that gets accumulated in a fund, and something to be looked into when you're looking at a VC manager. Finally, I think it doesn't get discussed often enough, unfortunately, but governance at a VC fund is extremely important and should take precedence over a lot of other things. Who sits in your advisory board? What kind of policies you have into place? Do you have documented policies? What do you think about exits? What do you think about conflicts, and how do they get discussed and addressed? Should be some of the questions which should get required attention.
Great. Thanks, Mandeep. I think that's all from the questions that I had for you. I think there are a couple of
I just want to add to what
Go ahead.
Mandeep said before we jump into questions. All the things that Mandeep pointed out, very, very essential. In fact, choosing the difference between a bad and a good fund manager can be so huge to your portfolio. It can cause even as high as a 25% IRR differential between a good and a bad VC fund manager. So make sure you ask all those questions in choosing a good fund manager, because if on an IRR basis every year, if a 25% difference is there in your portfolio versus had you chosen a good fund manager, it can make a significant impact. So before you invest in a VC, make sure all your bases are covered very, very well.
Great. Thanks, Nidhi. I'll just open it up now so I can see two questions. One is from Usha, who is asking, when you say VC fund, are you referring to AIF fund structure that angel networks offer? Or are there mutual fund kind of multi-asset structural VC fund available to invest? Can you name few reliable VC funds to include in portfolio? Any one of you can take it up.
So maybe I'll take up this question to a certain extent. So I think we are referring to a AIF fund structure, Usha, not what the angel networks offer, because what angel networks are offering is discretion is in your hand, where which company to be invested in is by you. Now, given by you, I'm generally referring to the retail investors, is they don't have that expertise of choosing a particular company. It is best that it is done by AIF, which are typically category 1 or category 2 AIF, and they decide which companies to invest in, monitor, and exit. The angel networks are offering a very simplistic way of allowing you to choose any single company, which right now is not what we would recommend, at least as a starting point. And yeah, so mutual fund is very different from an AIF. Can you name a few reliable VC? I think your host of this podcast, Chiratae, is definitely one of them. And there are several others. Maybe we can take it offline. You can reach out to us. But definitely Chiratae is very well known. They've been around in the industry almost, I think, four fund cycles. And I think they're about to launch their 5th one as well. So, very well known in the industry, and a significant track record of finding multiple unicorns. So, yeah, that's one of them.
Thanks, Nidhi. Anyone else wants to chime in, or I can move to the next question? Okay, so I'll move to the next question. I think, Mandeep, this is directed at you. How does one answer all of Mandeep's LP fund manager targeted questions for a young new VC team?
Very relevant question. But if you look at the market, the number of new VC funds coming up regularly, that will show you that there is some trick to this trade, right? And while the VC fund might be new, the people who found these VC funds, who set these up, are typically not new in the ecosystem. So it's their track record that a potential LP would want to look into, right? So how many number of years has that person or that team individually at least been in the ecosystem? What has been their sectoral knowledge or sectoral thesis? how much, which are the stellar companies they have invested in, which are the stellar exits they have generated, and how much money has been returned to LPs from their own specific deals. Because at the end of the day, VC business is extremely, individualistic. I am responsible for getting my own deals. I am responsible for managing my own portfolio and generating my own exits, right? So if somebody like me, who's been in a fund for some time and then goes on to launch their new fund, will be judged basis my own credibility that I have in the market. Of course, who are the others I can get in my team to set up the VC fund, and what kind of experience, expertise, knowledge, etc. they bring will all be taken into combination with mine. But for a new startup fund, individual track records will be much more relevant. This is my response. Happy to, please, if anybody else wants to answer anything.
Okay, I think then I can move on to next question. So the next question is, how does one go about assessing a wealth manager to guide? I can see Anupama smiling. Anupama, maybe you want to take
Yeah,
on.
okay, let me try taking that. No, so essentially, I think a wealth manager, what a wealth manager essentially does is tries to, kind of give you a holistic solution for your financial goals. So it's not about, investing in a particular product or in a particular scheme. It's about, trying to achieve the investment goals and setting up a framework, more importantly, in order to achieve the investment goals. So if you see your wealth manager doing that for you, which is, setting up the framework right to achieve your long-term investment goals, and that, of course, you kind of, through your various interactions with your wealth manager, it's very important that you don't get into a wealth management relationship with a wealth advisor where he or she is only a product provider. Because if that happens, then, then you are not really aligning, or you're not, letting your wealth manager align to the investment goals that you set for yourself. Well, so if you kind of see your wealth manager, guiding you holistically to achieve the goals, helping you diversify across different asset classes, and helping you achieve your investment objective, which could be defined either basis return, either basis your liquidity requirements over the life of your investment cycle, and your long-term investment objectives, then I think, the wealth manager is doing, their job. And of course, basics like looking at whether the platform is fulfilling, are you getting an institutional approach? Is the product team that's, if it's an institution, then is it backed by a strong product team? And do you have the entire process institutionalized, where it's not driven by a particular individual, but it's guided by the research and the analytics that go behind every advice that goes to you? I think also plays a very important role in ensuring that the portfolios are healthy and, and kind of are, kind of driven to achieve long-term performance on the portfolio. I think so these factors and the trust and confidence that you build, with your wealth managers, and that comes over a period of time. But, some of these factors play a very important role, in choosing the right wealth manager for you.
No, I'll just come in a little bit over here, given that this is pretty much mine and Anupama's main domain, to refer to. But a lot about what Mandeep said, ways of identifying VC, also are applicable to how you go about finding your wealth manager, right? The truth is that, yes, it's very, very important that you align yourself to an institution and a thought process that that institution brings with it. So to that extent, a lot of these companies now have recordable tracks to offer to people, right? So you can go back and see what the performance of some of these wealth managers is in public domain. How many mistakes have been made, because in this industry, with everything becoming so transparent, a lot of the information access that is available, it sort of allows you to not make larger mistakes, and institutes that have managed to stay away from that have actually come out looking sharper, whether it's the 3 panelists that were in, we're all top and right up there. And I think that what sets us apart from the rest of the industry is really that, the level of mistakes that we've ended up making is far lesser. Look, nobody intends to do badly with your portfolio, whether it is a wealth advisor or, you yourself. So to that extent, I think stay disciplined. Stay tethered to your overall investment objective. Maybe find an advisor who gets your investment objective and is somebody you can relate to, and build trust over a period of time. And yeah, keep it simple. Investments need to be super simple and super boring. The minute we try and do something exciting, we're bound to make more mistakes.
Thanks, Vidhi. Let me go on to the next question. The next question is, should we do PMS or only MFs?
I'll take this. I think, again, whether it is a PMS or whether it is a mutual fund really depends on how much concentration one is looking to bring to the portfolio. I think it's important to have a balance of both. I'm not saying one asset class is better than the other, because ultimately it is a vehicle for investing in equities. Look, PMSs come with their set of restrictions in terms of ticket size and stuff like that. So to that extent, it's important, if it fits your profile and if it fits your investment bucket, then yes, PMSs do come with a fairly large share of alpha that they can generate over and above doing a more broad-based strategy than mutual funds perform. PMSs typically do 20 to 25 stocks. Your mutual funds do 50 to 60 stocks. So it really depends on what you are looking to get out of the mutual fund. Statistics say that PMSs tend to perform at least maybe 1.5%, 2% extra than a more broad-based strategy. But we're also seeing that the last couple of years has been an aberration to this rule, right? We have seen everyone hugging the index a lot more than they used to. So somewhere having your foot in both places will eventually lead to a slightly more balanced return in the long run.
Okay.
Also, just to add to that point, PMS, you have a cost drainage in terms of the dividend tax that comes in the hands of the investor, because when the dividend gets declared on the underlying stocks, unlike a mutual fund, here the dividend tax is taxable in the hands of the investor. So, that is one tax leakage. And again, there is a tax leakage because should the fund manager churn in the portfolio, then the capital gains are in the hands of the investor. Unlike a mutual fund where it's a pool vehicle, and hence the tax element, and the investor is not directly taxed. So, and hence, like Vidhi mentioned, it's important to have a PMS in the portfolio if you believe the PMS will give you that outperformance of 2.5%. Because in order to have PMS as an allocation, you need to cover the extra costs that you would pay, which will not reflect in your headline return. So because these are costs which are outside of the headline return, and hence choose the PMS fund manager maybe only for the mid-cap bucket where you think that you will get that outperformance. Your large cap cover bucket, which is a core portfolio, can be as simple as passive funds and a few focused mutual funds, which also have 25, 30 stocks, and it meets the objective of return.
Okay, so the next questions also that we've got is about churn. So how often to trade or churn portfolio?
No, I think it's important to keep portfolios long term. Again, history has shown, the history records have shown that if you are long term investors, the power of compounding works wonderfully. So you need to churn only if there is a reason to churn. That could be, if there is a change in the fund management team or change in the thesis of the investment, only or change in a particular, asset class environment given the current market scenario. Otherwise, staying invested for long term really pays off. And so once having decided the framework, once having decided the asset allocation, stay invested. And of course, if the asset allocation framework, gives you a reason to rebalance, then of course, rebalance the portfolio. So should markets go up and your equity component goes up by, say, 10%, then reduce that allocation to get back to your original asset allocation. But otherwise, staying invested for long term really pays off.
Okay, so I'll add on to that the next question, which says, what are some returns metrics to look for popular asset classes?
Sorry, what are the returns to look for popular asset classes?
Return metrics to look for popular asset classes?
Sure. So equity as an asset class, one can, go with an expectation of about 12 to 14% over a longer period of time. Debt, especially in the current environment, looking very, very good. So your risk-free debt return on a plain vanilla GSEC portfolio is close to 7.2, 7.3. I'm talking gross returns here. Then when you move on to some of the high yielding assets, high yielding debt opportunities, one can of course look at returns upwards of 10, 11%. And your private markets, which is in the unlisted space, can give you returns anywhere between 16 to 25%, depending on the nature of the investment, early, mid, or late stage.
Great, thanks, Anupama. I think we have one more question, which says, what is the minimum ticket size to invest in a VC fund? Mandeep?
Yeah, sure. So, typically these are Cat 2 AIF funds, and the minimum ticket sizes are regulated by the regulator over
Correct.
here. Typically, they are minimum of 1 CR per product, but that is the minimum. Different asset managers can have different minimum ticket sizes depending upon whatever their choice is. Ours have also varied, and I know within the industry they can go as high as 10 CR, they can go as low as 1 CR. So it really varies.
Thanks, Mandeep. I don't see any more questions. So, I would like to, instead of summarizing the points, because I think there is just too much wealth of knowledge that we gathered here and discussed here. And I want to say that I think this is just one of the conversations that we are starting with, right? We will circulate and come back for a lot more conversations. To our audience that could not join today, we will have this recorded and out. But, instead of me wrapping up, I wanted to say that we are going to be doing more of these conversations. And with 4 of you here, leaders who are very passionate about the subject that we're discussing, whether, how women take decisions, how powerfully they take decisions, what kind of diverse portfolios they build, and of course, why is VC one of the options that they can consider. So if all of you could, do a one sentence summary or a takeaway that all of us should be taking with us today, that, that'll be a great way to wrap up this conversation. So, I could go around the table and call, or if someone wants to start, so maybe I could start with, Vidhi.
Vidhi, you're on mute.
I just want to say that don't let everything that has been said today and everything that is being said regularly on multiple forums when it comes to investments and returns and risk and all of that scare you. It's not so scary. I think the idea is to keep things simple, to stay disciplined, and just have a vision when it comes to money management. And like I said, it's actually quite a beautiful journey. There's something new to learn every day as far as the financial markets are concerned, investments are concerned, and you'll see how every additional return that you generate for yourself or for your family can go a long way in actually benefiting the ecosystem at large. So lean into investments and lean into VC, because there are lots of good things happening.
Great. Thank you, Vidhi. Nidhi, if I could move.
Sure. If in one line, if I have to summarize, my only thing would be, the suggestion to everyone would be that have the freedom of mind, know what is happening, be involved in investing.
Great. Thank you, Nidhi. Anupama.
Okay, my one line would be that, clearly women, I think this is a little gender bias, but I do believe that women make great investors. So involve women, in your decision-making, financial decision-making in the family. And the reason I say that, because, keeping portfolios simple, ensuring that you take informed decisions, following a framework, these are qualities which women anyway kind of you have or follow in the day-to-day routine life, right? So if you kind of get them involved in your financial portfolios, you will see a difference, whether or not they have the relevant investment experience. So my one line here is that women, make great investors.
Great, thank you, Anupama. And Mandeep, on to you.
And just one line, just do it. Just start doing it, and good things will happen.
It's pretty much like entrepreneurship. You just have to jump.
Just have to.
Great.
Thank you, ladies. Thank you for the wonderful conversation. And like I said earlier, this is just the beginning, and we're going to be doing a lot more conversations here. And I want to end with a fantastic comment that we've got from one of our participants, and I think that's the best way to wrap this conversation today. So they've said thank you. This was a very informative session, great for everyone, not just for women. The best I have heard in a long time. So here's to more women making their decisions felt, and more of us having this conversation, and not just women on the table, but everyone else in the ecosystem.
Absolutely.
And thank you for your time.